The fall of one of America's iconic companies, General Electric, on Business Talk with Jim Campbell. Ted Mann is a reporter in the Wall Street Journal's Washington Bureau, where he is part of a team covering business and government. He was the beat reporter covering General Electric and other industrial conglomerates for the Journal's corporate bureau in New York from 2014 to 2017. Previously covered transportation for the greater New York market, where he broke the George Washington Bridgegate scandal that had stared former Governor Christie in his age. His co-author on this new book, Thomas Greita, writes about GE for the Wall Street Journal as well, previously covering the telecommunications industry. And the new book, Lights Out, Pride, Delusion, and the Fall of General Electric. Welcome, Ted. An honor to have you.
Thanks for having me.
Let me ask you first, quickly, did Christie know about Bridgegate? Was he complicit?
His denial has always been very specific, that he didn't know about it in advance, and that if he was told about it while it was going on, he wouldn't have known what they were talking about, which is a denial that, has a hole you can drive a truck through, but that's his version of events.
Because it's hard to believe, because he was such a control freak, for anybody that knows how he ran that thing. All right, let's go to GE now. Is GE fallen or a turnaround?
I think right now that certainly the current company leadership would say that they are turning around what remains of the company. It's not the entity that it was 5 years ago or 10 years ago, and it's probably never going to go back to being what it was in the sort of broader business culture of the U.S. This giant conglomerate that seemingly could operate by its own rules and that could tell everybody else the right way to manage, and that told itself that it could manage anything. No one believes that anymore.
That's kind of very sad. I had kids go to Union, so I know Schenectady well, and that power, headquarters right in the middle of town, basically. One point housed 40,000 people. It's now under 2,000. One of the things that surprised me most was I know somebody that works there because I play golf at Saratoga a lot, that their cash flow got so bad, and the companies, that he said they were having trouble making payroll. Is that the kind of sense you got?
Yes, the major cash crunch that hit Power and the rest of the company, but especially Power, was very, very dire, and they really reached a point where there was not nearly as much cash as they needed to hit their most important obligations, and you really see that in them cutting the dividend. That's something they had done only once since the Great Depression, and then ultimately they've slashed it to a penny. That was the thing that was holding a lot of people in the stock. It was what made GE shares different than other company shares, even when the stock price wasn't great. Having to cut that off was a sign of just how bad the finances got.
There's a lot of revelations in this book. What's the single biggest surprise you uncovered in your mind?
It's a good question. Tom and I were both very familiar with the company, the day-to-day operations of the company, and some of these stories that are in the book are things that we had covered as they unfolded. The long struggle to close the Alstom deal, for instance, what seemed at first the successful separation of GE Capital. One of the more surprising things to me was just the number of warning signs that went ignored, particularly on something like Alstom, where you had months and months and months where there were people inside the company who just thought this was a mistake, that they were in the deal for the wrong reasons, and that they had showed up wanting to pay too much. And it's the sort of thing that if the management systems that GE was prized for were working, these were the red flags that could have helped them avoid a deal that now looks just disastrous.
Totally disastrous.
Jobs. Yeah.
Now, a hedge fund guy once told me this, and it makes a lot of sense. I mean, I did consulting for GE, so I know the culture. It's very siloed to begin with, but that the culture, the company needs an overriding mission, a sense of mission, but that it never was more GE than make your numbers, and that it was a soulless company. Do you buy that?
I mean, soulless is a tough word. Certainly, the focus on making numbers is a theme, and Jeff Immelt didn't start that. That's a culture that flourished under Welch as well. I think for many years, GE was a conglomerate that was getting away with being a conglomerate when that was falling out of favor for exactly the reason you're suggesting, that you needed mission and focus in the view of the market. But GE's performance and the solidity of the company, it seemed like it was never going away, I think allowed them to be in many, many businesses at once, when so many other companies were being forced by their investors to winnow down, to focus, to pare away things that were not core to a central mission. And that's really, I think, what's happening to what's left of the company today. Coming out on the other side of this, you're going to probably have a company that makes jet engines and power turbines, and maybe still makes some healthcare equipment. But so much of the rest of it, which now look like distractions, is gone.
We'll do a little forensic analysis now. Who killed GE? I was surprised to learn. I didn't realize it was so bad. They were $600 billion market value at peak, and they're at $50 billion now, which is a pretty amazing decline. Now, the conventional wisdom is Welch, brilliant, best corporate CEO ever, and Immelt kind of a failure. But that's not really totally fair, is it?
No, that's not totally fair. Jeff Immelt was the CEO for 16 years, so he owns a lot of the performance of the company over that time. But it's absolutely the case that the GE he inherited needed to be transformed, that the stock price was already falling when Immelt took over, and they had built up this reliance on finance that I think you can see even in Welch's final act. The company was realizing that they were too reliant on financial services for profit. I mean, that big deal that Welch stayed on to try to close was to buy Honeywell, which would have essentially boosted the industrial share of their earnings, and that didn't go through. So I think that it's fair to make Immelt accountable for all of the decisions they made. I mean, GE Capital rose to its largest size under him, not Welch. But it's also true that what he inherited was a company that needed to change for external reasons, because globalization was becoming a thing, but also for internal reasons. It was not going to keep chugging along the way it had under Welch.
And also, Welch grew that company 20% compounded the stock price for like 20 years. And really, I felt that there was a lot of earnings manipulation going on at Capital, because they could change the reserves for what he needed to increase the quarterly earnings, which that also distorts his legend in my mind.
Yeah, I mean, that's part of the legacy of the company. The part of the value of Capital, within GE Capital, there were lending businesses that were very good at these niche lending markets that big banks didn't want to be in or didn't understand. But the other value of GE Capital to GE was enabling it to constantly hit these earnings targets. And we've lost track of the number of stories we heard about this over the course of reporting on the company and writing this book, but selling off half of a parking lot on the last day of a quarter, to make a number. Yeah, selling off a share of a power plant on the final week of a quarter, then buying it back again. That stuff happened all the time. And it's absolutely part of that legacy of Welch's of always, setting and beating targets, that they were able to do it with this giant bank that was attached to the side of the company.
And I was surprised also, you said that Industrial sold receivables to Capital, which seems a little sleazy.
I mean, I think they would defend it as being, not illegal, but yeah. It's certainly some of the sell side analysts we talked to about that, particularly some of the ones who caught on to that early, saw that as a real warning sign that the way the money was moving within these units and across Capital and the industrial businesses was a sign that the actual top line numbers being reported were not really reflective of how well the company was doing.
Did Welch pick the wrong successor? Jim McInerney and Bob Nardelli seemed like incredibly accomplished people, and Immelt won out. Was that, in retrospect, the wrong choice?
Well, we know that Welch thought so. He was saying that to others, and he said that to Tom. That he felt that was one of his most important choices, and that it had not gone the way he hoped. It's a tough counterfactual. I think it's important that we not dump on Immelt for stuff that we can't really know, and I do think that both of those other men would have faced the big challenges that Immelt did in those early years as CEO. He always points to the fact that, he'd been on the job 4 days when 9/11 happened, which was a shock across all of these GE business units. And we don't know how McInerney or Nardelli would have tried to reposition the company in the early and mid 2000s, and if they would have made the same decisions in 2005, 6, 7, going into what became the financial crisis that Immelt did. But yeah, I think that if Welch, by his own measure, said, one of the most important decisions he would make as CEO is who he was going to tap as his successor, and he clearly didn't think that he'd made the right choice. But by the time all was said and done,
too late. All right, we'll be back with Ted in the second segment. We'll look a little bit more of some of the may call them mistakes under the Immelt era. We're back with Wall Street Journal reporter, GE expert Ted Mann. I want to get into some of the biggest issues in Immelt's thing, but first off, just finishing where we were going on CEO succession. Was John Flannery, who succeeded Immelt, was he a fall guy?
That's a good question. We don't call him a fall guy. I think one thing that is clear in the story we tell in this book is Flannery showed up and uncovered a much larger mess that he had to clean up than anybody expected, including himself. And he set out to basically try to tell the ugly truth about what was in the company, and got pummeled in the stock market for that. If you look at what Larry Culp is trying to do with GE now, the man who succeeded Flannery, it sure looks a lot like the playbook Flannery said they were going to have to follow. It sort of seems to me that Culp is no fault of his. It is basically getting the leeway to make GE take the tough medicine that people didn't want to give that leeway to Flannery. And so it was a pretty raw hand that he was dealt.
Do you? I've heard that there's some cynics that say Culp executed a coup. Flannery put him on the board. He was an only outsider that I think's ever run GE. You buy that at all?
The notion of it as a coup? Not really.
Yeah, the Culp set him up, and
I don't really. No, I don't think we have any evidence for that. As you say, Flannery did put him on the board. Culp was, because of his track record at Danaher, he was constantly brought up by sell-side analysts who were sort of pecking at GE even back in the Immelt days as, hey, look, like there are conglomerates that are being run well and run tight and they're high quality. And so they would bring up Larry Culp. So in a way, putting him on the board, it was a sort of an obvious gesture GE could make that they heard investors who didn't like the way they were operating. I think you just look at the stock chart when Flannery was having to disclose this sequence of terrible news, and people were growing less and less, comfortable with the direction of the company. So I think it was a reaction to investor panic about, whether this thing was going to survive. I don't think we have any evidence that there was, dastardly.
Yeah, one of the things that amazed me, when you come in like that, you want to get all the bad news out and take the write-offs. So I was stunned that he didn't, that long-term healthcare thing, which is devastating, he didn't bring that up until sort of his second quarter.
Yeah, and that was the shoe that dropped that changed everything. It's also just amazing how that was hiding essentially in plain sight for years on the company's books. I don't think we have this in the book, but there was a period where we were writing, I was the beat reporter, and we wrote a story about GE Capital, and we made a graphic just to show how the company had changed over the years. And in the graphic, we showed them selling all of their insurance businesses in 05 and 06, which is what they'd always said. And then when they did the capital separation, lo and behold, there was a little line in the stock deck saying, we have a few insurance assets here. And that turned out to be this incredibly toxic stuff that had been hiding in discontinued operations and no one even knew was there.
Was that I remember that Wall Street Journal. Was that you? That it was multi-page, right? And it may even have been a Saturday journal, and it had their whole history. Yeah, I remember that.
Yeah, that was Tom and me.
let's talk about Immelt a little bit for some of these things in his tenure. But the first off, to be fair, what would you call his biggest successes?
I mean, I think he was directionally right about a lot of stuff. The GE Digital was a disaster, but Immelt was very early for an industrial CEO in thinking about all of the data that is going to flow out of heavy machinery and civil infrastructure, and the fact that there will be lessons to be learned there. Other CEOs made fun of him for that, and then a year later were standing up their own digital divisions. So he was very good at long-term thinking like that. Another example that a lot of people would give is the way he changed out some of the older business lines he inherited from Welch. It wound up being about 65% of the portfolio. And he was trying to get out of commoditized businesses where you were not going to outcompete LG or Samsung. So like appliances, you just weren't, in their view, going to make a high margin on a washer anymore. And he did, especially in those early years, in the early 2000s, think about going global and getting growth in new markets because the economy was changing and because they were coming off of a giant peak in the power market. You were not going to have growth here.
We did a show with insiders at GE on this GE Digital, and what impressed me was they knew that they didn't know what was going to happen, and there was a leap of faith. And can you imagine a big corporate entity like that taking a leap of faith? It's really a high risk strategy, and it was unfocused and throwing too much money and all that stuff at it. But I was impressed that they would bet the company like that without even having the confidence that they knew what they were doing. I mean, they were open about it.
Yeah, and it looks pretty bad in hindsight, just the degree of the spending. Was, I think they should, as you're saying, I think they should get credit for knowledge that they would have to have some answer to these questions. I think what now looks like the smarter decision would have been to have some sort of partner who knew the software game.
Yeah.
And to sort of, not assume, as GE liked to assume, that they could manage in any business because they were.
And I think that they had false assumptions of what Predix was. It was presented as like Microsoft's operating system. You see Monopoly, but as I saw in your book, it really had to be customized very closely for customers, which defeats the whole purpose of it.
Yeah. And that was a big frustration to some of the folks on the financial side in the company who were looking at the spending and seeing that there was not going to be that sort of replicable return that you get in a software model because they had to customize.
All right, let's go through some of these issues. We've talked about Alston, the splitting and selling of capital, right? Looks like a pretty good decision, other than it took away short cycle cash. And where did all that cash go?
Heavily into stock buybacks at prices that will make a current GE shareholder blanch. The decision to plow as much as they did into buybacks is one of the most consequential things that they did, and it looks terrible now. They failed. They sold, what were mostly really good financial services businesses, but didn't really shore up the foundation of the rest of the company and didn't provide for a replacement of all of that stream of the sort of higher quality cash earnings that they were going to need. What
I find interesting is that if you go back in 1980, Welch's whole thing was we need new revenue streams because industrial slowing and Japan's going to take over the world, right? Mm-hmm. And that logic was become a conglomerate. So they go now to this, and the whole logic is we're out of control. We have no focus. We need to focus. But I said right away, at some point, they're going to end up with the same issue, which is reliance on an earnings stream that's too long-term and cyclical. But it happened quicker because of the virus. Have they just gone back and repeated the same,
That's an interesting question. I think the argument from some of their shareholders and some of their critics would be, you do need to go back to that more focused industrial mission. But that might mean breaking up even more. And it might, because in another way of viewing it, capital was what was subsidizing a conglomerate model that no one else was getting away with running anymore, because the market had decided that is not an efficient way to run businesses, and that the jet engine business should stand alone and the power business should stand alone. So they may, I think, wind up in a position where there's even more pressure to separate further, because that's what so many other businesses have shown is a more efficient way of operating.
All right, third segment coming right up. We're excited to announce that Jim Campbell Radio has now been unveiled on YouTube. You search Jim Campbell Radio. When you get there, please subscribe. You'll get all our updates. Content is regularly updated. And Forensic Talk with Jim Campbell and Business Talk with Jim Campbell, all of our podcasts are right there for you. All of this new consolidated data, content updated regularly. Jim Campbell Radio. The book is Lights Out, Pride, Delusion, and the Fall of GE. It's just out. We've got the author from the Wall Street Journal, Ted Mann, here. And we were talking about some of the big issues in Immelt's tenure. One of the things that hit me is that he's a corporate executive, and he sort of ended up in the role of an investment banker, which he didn't have the skills for. And you see them buying the wrong businesses at the wrong times or selling the right businesses at the wrong times, like getting into oil, et cetera. I think you called it fad surfing.
Yeah, and that's a phrase that's used by a rival of his, a CEO who was fairly critical of his track record. One thing we learned reporting the book was that when the succession contest was going on under Welch, one of the strikes against Immelt, as reported to the board, was that he sometimes overpaid. And that became a real track record as CEO, that he did not have a good track record on M&A and was seen as coming in a little late to markets that seemed hot, but you were too late to come in and get a good deal. And that's one that has always bothered him, that people say that about him. But I think the record is pretty clear that
I got to know Bob Wright a little bit. He ran NBC and was right. Welch's like number 2 guy. And one of the things that he told me was that he felt Immelt was intimidated and waited way too long to restructure Welch's company.
That's interesting to hear, especially coming from Wright.
Yeah.
By the end of Immelt's tenure, the degree of restructuring that he had done was one of the main points that the PR shop at GE would boast about. They would use that figure of 65% of the portfolio having been changed out. But I think Wright is on to one of the criticisms that we heard a lot, which is that there was a sort of, there was an unsure posture in the early years about how much to change and what to change. I think in Immelt's defense, people would say, A, he was dealing with crises right off the bat in key business lines for them, and B, I think the defenders of Immelt would say, he was busy fixing the things that had to be fixed fairly quietly internally, and especially dealing with that reliance on finance.
Now, he had a big internal organic growth versus Welch always doing acquisitions. He invested in R&D, right, for one. And did that not work?
No, I think it did work. I think his track record on R&D investment in some of the businesses was quite good, and aviation is probably the single biggest example there. There were some sell-side guys we talked to as beat reporters who covered the company for many years. One of those guys told me right when I was starting the beat that his main knock on Immelt was that the cupboards were pretty bare by the end of, on Welch, was that the cupboards were pretty bare by the end of Welch's tenure because there was such a focus on efficiency, cost cutting, and hitting profit targets, that there had not been a lot of R&D in areas where, jet engines, you have to spend a lot of money getting years ahead of what is eventually going to reach the market. And I think that in addition to the other things, that is a point on which the defenders of Immelt say he was really correcting a bad trend and that he doesn't get enough credit for how much he invested.
Which leads me to, we talk about a little bit about power and jet engines and aviation or whatever. Their financials are very opaque. Are they trustworthy? And I'll give you an example. And Steve Tusa told me this, who's the JP Morgan analyst, that there's a big difference between cash and net income, as you say, right? Because they bring in these contracts, they sell the turbines for a loss, but they book the present value of the profit stream from service. And that's highly assumption-based, which gives a lot of way to, and if you're off by a slight in the discount rate, not to confuse people, you can turn that into a loss stream. Do you trust their numbers, and do you get a sense that a lot of that was going on?
Well, I mean, we know that the accounting, is particularly the service accounting, the contract accounting in Power, we know was extremely aggressive. Um, and
Yeah.
essentially we've been told that now by two successive management regimes that it was way too aggressive. There was not nearly the cash there that an investor might have assumed just looking at the numbers that were in the press release on page
Yeah.
two. And so, yeah, the numbers are opaque. I think the question of whether to trust them, that's not really for me to say, but certainly this is a company that has, and it's a company whose investors have learned their lesson about what they know and don't know based on the numbers that are reported. I think now it seems unlikely to me that anyone is going to be trying to play the games that were being played a few years ago in the Power, in that contract portfolio. Just seeing how quickly that got out of hand and how bad it ultimately was for the company.
I wonder now if so they have this ongoing cash problem. They have a good aviation business, which has been beat up by the virus. They have
Yeah.
a good health business, right? And they no longer have the other good businesses. Are they going to be forced to sell one of those? And Power has a very slow growth trajectory. So, and that's
Right.
their whole business. That's their whole portfolio. Are they going to be forced to sell one of the family jewels then?
That's the $64,000 question for the next year or two. It doesn't. I don't think they're making the noises that they would make if they wanted to communicate that that's what they want to do. They being the current management. Certainly, Culp has not said that that's what he intends to do. I do wonder going forward, and it will depend on these factors that are not in their control. Which again gets back to what was supposed to be provided by that giant complex conglomerate model. Immelt would say again and again that the great thing about their model was that they could have a rough year in the power market or the oil and gas market, and all these other great businesses would sustain them. And if it turns out that model was a house of cards and you couldn't actually manage it in a stable way, that means they're not just any other company, and they're subject to the whims of a virus and the whims of the markets, just like any other company. And that's, I think, where GE finds itself.
All right, let's talk a little bit scandal now. This dual jet story, that he flew an empty jet with him, like he was some Saudi Arabian prince or something. How bad was that? Also, I was stunned. 700 GE executives got car leases given to them.
Yeah, the perks were significant in that company, and there were the people who were hammering away about bloat and not enough fat being cut look pretty vindicated on that. The jet thing, I got a tip about it years ago and couldn't confirm it, and then Tom immediately took over the beat and immediately got it confirmed, which made me very jealous.
Now, according to the book, he got $168 million of compensation between 2006 and 2017, while the stock value got destroyed. Is that wrong, or do we that in the long run, as you said, maybe he was doing the right kinds of things, but they're not going to show up for a while, if ever?
That's not for the reporters to say, but
Okay.
but it is something for the shareholders of the company to consider. They're the ones paying that compensation, and they're the ones who are paying compensation at these very high levels for an industrial company. Are they getting the value that they're paying for? That's certainly a decision for every shareholder.
Not if the stock is at $5 after.
Yeah.
Did we know that they weren't covering the cash flow was not covering the dividend for years? Did we know that?
No, Flannery said that, and it was it was a surprise to me to hear him say that. Immelt disagrees with that assessment, but I don't particularly. I don't know why he thinks Flannery is wrong. And Flannery was quite emphatic when he stated that. And that, again, it just goes to the central question here, which was how much could you trust the way this company was telling everyone it had everything under control? Something as sacrosanct as the dividend.
I find it disillusioning, because this was a company that prided itself on being conservatively run, like an IBM kind of thing, and all these numbers end up being, from the service profits to the cash flows, I mean, how could they not know whether cash flow was covering the dividend? It seems kind of like, pretty basic, but clearly it wasn't for years, right?
Some of the people we talked to for this book will say on this question, on the question of whether there were red flags on Alstom, they will say, hey, look, everybody agreed this was good. No one ever came to me and said, this is a problem. So if anyone thought this was going in the wrong direction, they had an obligation to speak up. And I think that just gets to the management problem they had. This was not a culture in which it behooved you to speak up and say, we're not doing the right things. And the other argument for a conglomerate of the complexity of GE was that they had such great management practices, and this matrix management would allow them to see through all of these levels deep into all of these disparate businesses and catch a problem like this one with the dividend. But clearly the vision was not sufficient. Either someone was closing their eyes to the red flags, or you couldn't actually see the biggest problems as they were sort of about to bubble to the surface. So either way, right, the model was flawed.
Our final national segment, we'll talk about the future of GE coming right up. Our guest from the Wall Street Journal, Ted Mann. Should GE be broken up?
Not on the say-so of a Wall Street Journal reporter. But clearly that is one of the options on the table. I don't think that the current management is sort of making the noises they would make if that's what they wanted to do. But there are certainly shareholders of the company who will say, you have a jet engine business with a short-term huge problem because of COVID, but tremendous technology and growth possibilities. Why can't it stand alone? And you'll definitely hear people say that for the next several years.
Now, I think, they have a huge cash flow problem, which we've said, but I'm wondering, Danaher was brilliantly run by Culp, but it was small. Mm-hmm. And there's no growth in power unless they're diluting themselves. Might he, over 10 years, build a mini Danaher back a little bit to what GE was, but on a more manageable scale?
I'm sure there are people who have been hoping that since he joined the board, let alone since he became CEO, that there is a model out there for a conglomerate that can be run tight, efficient, not in the flabby way that the GE was run. So certainly I think there are people who are hoping that is the direction in which it goes.
Now, there's this comment in your book. I guess it's well known that Immelt was kind of known for success theater, not entertaining a bunch of dissent, which you kind of just said before. Is Culp broken through all of that? Does he understand the business under the table?
I shouldn't say for sure. Tom is closer to the current day-to-day management of the company than I am. But I do think that the message that Flannery was sending when he was walking around saying no more success theater was essentially telling everybody, like, you had better give me the full accounting of all the problems. And my guess is that is exactly what Larry Culp would be saying too. No one wants to be surprised by $15 billion worth of bad insurance again.
Yeah. Now, we haven't talked about this, but I think it's fair to talk about the employee morale through all of this and what's happened. That a lot of these folks had all their money, including Bob Wright, who told me he had like 90% of his money in that stock. And he was going to use it for trust for his grandchildren. How's the morale?
I mean, certainly we're back up from the low of a couple of years ago. But when the company was falling during the final months of Immelt's tenure, and certainly when Flannery was sort of unveiling all the bad news, this was really hard for people. We talked to people who were very emotional about what had happened to their company. And it is still one of these American companies where there is like it is a family. For all of the criticism we heard from people who work there and all of the complaints they had about the things that weren't done right, there's a tremendous sense of ownership and pride about the company. So this was really, really very upset. I think certainly we're not in the doldrums we were in 2017, 2018. Clearly there's some there.
I gave Bob Wright a little grief about this. This is before the election of 2016, and he told me he greenlighted The Apprentice. So I said, "You're the guy that's responsible for this guy suddenly being perceived as a big, brilliant success." But he was very bullish. This is back then, before the election, that Trump was going to be good for the country.
I heard that from a few GE people. Yeah, and I also heard there were a couple members of the GE board who told me very confidently that the presidency changes you and that he would grow into the office.
Which is going to be a question I had for on the, Trump is focusing on nationalism, America first. Mm-hmm. All of that goes against Immelt's vision, though.
Yeah,
which was international markets closely aligned with countries.
Yeah, absolutely. Immelt came to Washington in the spring of 2017 and gave a speech about continuing the path of free trade at Georgetown. I think he was right in seeing that all of that was under threat based on how the election had gone, and it's even more so now.
I'm a big Buffett fan, right? And I used to compare GE and Berkshire because they were both successful, had about the same market value, but completely different models. GE was corporate-driven, headquarters-driven, Six Sigma. Everybody had to follow that. And Buffett's the exact opposite. And Buffett has won. But he's a conglomerate model.
Yeah, I certainly there are a lot of people who would say he's won. I think we can say that the conglomerate model, that heavy corporate conglomerate model, where GE was really one of the last practitioners of it, I think that is probably over. It will be tough to make an argument for that headquarters heavy model to come back.
What's the reception you've had from GE on the book?
We have had a lot of great feedback. People have come out of the woodwork to say that that they like what we wrote and that they think we got it right. And there are people who are unhappy with parts of it, which we knew. There was no way to write this story without getting some noses out of joint. But overall,
how about Immelt?
Oh, he didn't like it. We've heard from he's got a PR representative, and he feels that it was unfair, and that I think that's been true since he left, and in all of the newspaper coverage too. I think he really feels that he's been scapegoated for things that were not his fault.
Did he cooperate with you? So you kind of got his inside perspective or his defense?
We had spoken to him a few times for the long piece in the journal that was the sort of genesis of the book. So we were familiar with his version of the events, and then what we really wanted and what we went out and got was what it looked like to everybody else around him inside the company.
By the way, my daughter joined GE, a few years ago. She's gone, and she worked for Beth Comstock.
Oh, really? Who
was really a visionary, and Immelt very close to her in terms of providing him strategy. Mm-hmm. Sasha is very big on Beth. So, but she was ousted too with the new regime.
That's right. And she was a pretty divisive figure in the company. There are many people who found her to be a visionary, and there were a lot of others who disagreed with her approach and didn't want to see her rise to the position that she eventually rose to. That was a theme we heard a lot.
The book is Lights Out, Pride, Delusion, and the Fall of General Electric. Probably the first book on the current status of GE. Bill Cohen is writing one.
We'd heard that.
It's going to be called, I don't know if I can say this or not, but a great name, I thought, Power Outage. That was at least the name that he has. I don't know when it's coming out. Search Jim Campbell Radio to get all of our archives. Thanks to Ted Mann. Thanks for our national audience for listening. We'll see everybody on the next edition of Business Talk with Jim Campbell. We're excited to announce we've got Jim Campbell Radio now on YouTube. It's got all of our business talk with Jim Campbell, our forensic talk with Jim Campbell, all in one site. All you have to do is search Jim Campbell Radio, and then please subscribe so you'll be in touch with every new show.